The S&P started a busy week with a little bit of a down day. In fact, the biggest down day that we've had on the S&P 500 in nearly 100 days. Let that sink in for this a minute. So I'm going to break down the technical ramifications of today's quote-unquote sell-off and what it means and how it impacts expectations for increasing near-term volatility and what that may look like. So that's what I'm going to break down in today's video. I'm also going to show you a bearish trade. Yeah, that's kind of hard to believe, but we're going to look at a bearish trade today and where we might be able to find a sector that's been doing really well but now may be rotating out of favor, and a way to take advantage of that even with earnings coming up. So let's go ahead and get started. Today is Monday, January the 29th, 2018. This is the market outlook from marketscholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Keep coming back. Subscribe to my YouTube channel by clicking that red subscribe button right down below the video here. You can do that right now while you're watching. Also, while you're down there, hit that thumbs up icon. That lets me know two things. Number one, you got some value out of tonight's video. Number two, you want me to do it again tomorrow. So one click, easy way to give us feedback on that. Scroll down further and comment on anything that stood out to you from tonight's video. Finally, join my daily email list that I send out in conjunction with this market outlook video, where I send out time-stamped hyperlink summaries of everything we talked about, so that way you can kind of fast forward and move to the segments you want to hear, as well as a list of all the overbought and oversold clusters in the S&P 500 every day. There's a link that I highlight for you in the description down below that will take you there. You can join that list. Follow me on Twitter for more content in addition to these videos day in and day out. My handle's up on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet. It's always pinned to the top of my timeline. You'll be able to see it there. Finally, join the Market Outlook community. Over 800 of us there. You can see the link down in the description below as well. Click that link, join the group, comment, and interact with everybody else, with others that are watching these videos daily, just like you are. All right, let's take a look at the S&P 500 here. First off, with the market forecast, you can see not an engulfing pattern, but a Harami pattern, which is essentially the opposite of an engulfing pattern when you have an inside day like this, where the body is completely inside and ideally kind of centered within the longer range, longer candle, the bigger body of the previous day's candle. So we talked about this prospect of a near-term divergence setting up. You can see a lower high developing, potentially, of course. Intermediate confirmation signal, bullish intermediate confirmation signal. The last one we got was back here on this near-term run. We talked about the possibility of that not working out very well, and it worked out pretty decently well. Of course, don't assume even the best scenarios for the intermediate confirmation would come out with that result, right? That was a pretty decent result, and this was not one of the best scenarios. So, and of course, now we're even further along in this near-term rally. So an intermediate confirmation signal at the end of a 20 some odd day or close to 20-day rally, near-term rally, not the best time to take that really short-term signal. So that being said, you look, the intermediate posture is strongly bullish. So while it's strongly bullish, we're not looking for any significant pullbacks. You can see where Fibonacci retracement would be just for the near-term pullback. And I mean, down to last week's low point. Well, not really even last week's low point. There's last week's low point. That's right at the open. It'd be more of last Wednesday's low, getting down to about 282. 28.25 in that area would be the prospects for a near-term pullback. These target for a near-term pullback. And remember, any near-term pullbacks are not going to be significant when we're this bullish. They add on to each other. Momentum catches up and it builds, but it doesn't start with any significant pullbacks right off the bat. Not when the near-term line has been this bullish for this long and the intermediate posture has been this bullish for this long. I mean, again, we're we're now 5 months along in this intermediate run, where the typical intermediate trend lasts 1 to 3 months in between low points. Not just any low point, because we got a couple low points here, but a low point that brings the intermediate line down between 20 and 50, and below 50 at least. And so, like I said, we're 5 months along in that process. You look at the market sentiment. Market sentiment is back up almost that 90th percentile where we got in November when we were, very strongly bullish. Of course, we're much higher now on the S&P, not much higher on the index itself. Not very often that we even get to 90 on market sentiment. So again, another kind of a long-term divergence setting up on that one. But again, that will take weeks to play itself out. Not like this near-term divergence, which can play itself out in the next couple of days. So that's what you got going on in the S&P, the Dow Jones, and don't put a lot of stock into this pullback today. It was not as much as it got a lot of press. It was not that big of a deal. In fact, it didn't even really completely reverse Friday's move. So grain of salt, right? Big time grain of salt. Near-term divergent, intermediate confirmation signal on the Dow. This one's a little different in that the momentum line dropped to a sharp low point. So we haven't had that steep of a low point since December 31st. And of course, we've already talked about the idea that this low point on December 31st is more artificial, obviously, because of what's happened before and since. So that was the last time. Before that, we're looking here in December when we got a pretty decent close there that brought the momentum line down. That was coming off of a brief, you can see these other times produced a brief weak bearish posture here. And so, there's that possibility that this one could produce a weak bearish posture ultimately. Here's the NASDAQ composite also forming a Harami pattern, also forming the possibility of a near-term divergence. 7,400 would be the low point that corresponds to that near-term low. Not an oversold momentum line on this one, but a short-term bearish pattern. You can see a nice, easy little, however you want to draw this trend line here, coming up along those low points. Breaking those low points would be a short-term weak signal, but of course, like I said, any short-term pullbacks right now, any near-term pullbacks right now are not going to be very big. Most likely. Now, granted, we have a lot of news this week, but most likely they're not going to be very big because they usually aren't when we're this bullish and this far away from moving averages like that. And then finally, the Russell 2000, more bearish in all of them, and seeing and the lowest momentum line it's had since, again, discard the December 31st one. But the last time we had momentum lines this low, we had a bearish posture develop out of it. So you can see this near-term line did not get above 50 this whole time. Close, but did not get above 50. So it's had a few days now, and you can see where there's some obvious intraday support here that if we were to break through would put that 1575 level. So things are looking more bearish in the short term, but not bearish enough to where we'd say, okay, we really need to start altering things. If it lingers or if it starts to get a little bit more bearish, which is not expected, right? Because the strong bullish posture, we get weak bearish moves, but that will lead to more near-term highs and lows, more ups and downs, and then that increase in frequency of these near-term highs and lows will ultimately produce more of a bearish posture that we're just not anywhere close to yet, because we haven't had, again, going back to the S&P 500, we haven't had a lot of near-term highs and lows. We're still forming a near-term high, and it's been that long. It's been all year long we've been forming this near-term high. So until we get something like this, that's when you start looking for more of a bearish posture to develop. And of course, that's all we got right now. So when you take a look at the long-term chart, you can puts today's move in context, especially compared to just the last week's move, much less the 4-week move that we've had as we've elevated off the 50-day moving average. So that's what it's done. We're still way far away from the 50-day moving average. Well, again, as this line, this MACD, which measures the gap between these two lines, as this starts to slowly creep over and move over to the downside, as it did back here, the last time it got to the highest point ever, we started to get more and more arrows, but it took a year and a half, right, before we even got a significant move below the 200-day moving average. So, you know, don't expect any moves like this, or even for that matter like this, anytime soon, because of how far up above. You notice none of these occurred when we were this far up above the 50-day moving average. We take a look at the 3 green arrow chart, which is right here. Nope. Yeah, that one right there. So you take a look at the 3 green arrow chart. Of course, we still have 3 green arrows. You notice the stochastics has now crossed below its moving average, but it's kind of hard not to when it's that high. The MACD still hasn't crossed below its moving average. Remember, the MACD typically grinds its way down to 0, and the fact that it's way up here means that grind is going to be even longer than the normal grind. So we're going to really kind of flatten out and go sideways here. And look, even today's move didn't even get us to the 8-day moving average. I mean, I've shown you this chart before, and I'll show you again just as a reminder here. Take a look at the MACD now compared to, you know, how far up above we are up above the 8-day moving average, right? This, you know, you can see when we get, we can have some runs above the 8-day moving average, but you know, there's periods of time where we go below 0. Look, we haven't been below the 8-day moving average. If it wasn't for that December 31st drop, which again, you know, was fake. I mean, look at the line here, and you can see basically we should have gone up just a little bit and continued that line up higher. So I mean, that was pretty much, you know, a fake news, so to speak. And because it was year end, it was, you know, the last day of the year. There's some weirdness that was occurring with that. So, barring that, look how long we've been above the 8-day moving average. Really, since mid-November. A little bit of a drop right there on November the 17th. So before Thanksgiving, it was the last time we've been below the 8-day moving average. And if I were to now, you know, do the same thing, you can see the same thing applies for the 17-day moving average. Whoops, not there, right here. Take a look at how far below, how long we've been above the 17-day, and you can see again that mid-November, couple of days, barring that, it's been this whole time, you know. And look, we don't go this long without drops below the 17-day moving average. And just about every one produces an intermediate low point. Now, you know, this one didn't. It was close, but it quite didn't. It brought the stochastics down below 50. Didn't quite bring the intermediate line below 50 on the market forecast. But you can see every other time since. If I were to go out a little bit further in time here, give it a second to load. There we go. You can see, there's a brief period of time right there, but you can see how that was that last. I've compared this current move to this one because again we had a 1-day drop below the 17-day moving average before we bounced right back up, but we had all that time, and then there's that this drop that we had, kind of an extended period of time that we had. The price below the 17-day moving average. Well, that was the last market sentiment low point. There's the election right there, the presidential election. So, you can kind of see how this works in conjunction with the market forecast indicator. Well, look how far up above we are, the 17-day moving average. We're more than 50 points, more than we've been over the last couple of years. Now, granted, keep in mind, the price is higher, so this is as a percentage. That number's going to be different than it would be, say, back here at 2100 or 2000. So keep that in mind. But regardless, we are way, way, way up above that 17-day price. And you can kind of see how same thing applies. We get way up above it, and then we kind of trend our way down. Get way up above it, and we trend our way down as we flatten out. Get way up above it, and we trend our way down as we flatten out. And you can kind of see this was probably the fastest that we got from up above it to down below it. But again, that was that 4-month period where we were up above for so long, the 17-day exponential moving average. And the reason why I highlight that particular one, because it's the one that we use in the MACD on that 3 green arrow set. So you can see that was probably the fastest one to get down below, because again, a little bit, that's a little bit different than all the rest. All the rest of them grind down, grind down, grind down, grind down. And so, we would expect that we'd grind down, but don't be surprised if we don't get a move kind of like this because of how long we've been up above and how far up above we are. But again, even a sharp move down below the 17-day moving average would still keep us well up above the 30-day moving average. I mean, we are, the price level up above the 30 is just insane. So now I'll change that MACD down there to the price up above the 30, and you can see very similar patterns. Again, get up to its high, grind down, get up to its high, grind down. Same thing as we talked about before. Well, now we're 100 points up above the 30 or 6-week moving average. Very, very, very sharp move. We were probably supposed to grind. We started to get a lot of ovals right here, right? A lot of ovals right there. We were probably supposed to grind down right there, but we didn't. We had this kind of boom move up higher in 2018 that took us up. So don't be surprised if we don't get back down to 50 and then grind our way a little bit slower. That last 4-month move here, you can see how we were grinding. We got a lot of ovals. We never did get below and produce the intermediate low point. We got that last push, and then we had the kind of a sharper drop. So again, similar thing where we were grinding. There should have been an intermediate low point there, but we had a boom, unexpected, late push higher to continue the intermediate run longer than normal, and then it produced that kind of pattern. So if you're looking for any kind of pattern on how you can expect this pullback to occur, right there, March to mid-April is a good pattern, considering that's the last time we've had this type of move. Maybe not to the same extent, but this type of move, with this type of market forecast pattern. Here's the good visualization of the inside day today. The high of the day was early. The low of the day was late. We closed right at the low of the day there. The whole day's range closed inside Friday's range, just in opposite order of what we had on Friday. But we didn't quite get down. So we had, about a 2-point range here. Let's see, right, go to the 1-year chart. We had roughly a 2-point range, a little bit of a gap. We closed at 286.58, the high today. So just a little bit between the close on Friday and the high today. So you're looking at just over 2 points in the range and 90 million shares being traded hands. 90 million still very high. It's at the average. The average is as high as the 52-week range as possible, which is interesting when people talk about how weird it is that the VIX is high and the S&P is going up to highs. Well, the same thing with this. It's not just the VIX that's high. It's not just kind of some irregularity with how the VIX is computed or anything like that. No. You can see volumes are higher as well. The highest of the 52-week range here. Now trading ranges are higher. You can see the trading range over 2 points. Right now, this point here it's just over 2. So today's range with the gap is just over the average, and the average is at its highest point of the 52-week range. So things are pretty volatile right now, and again, that will just lead to more ups and downs. And again, let's go back to that period of time, that March right here, this period of time right there. See, we didn't get that. We didn't have that late push accompanied by higher volumes and higher trading ranges. They stayed relatively low and then picked up. So, again, you can kind of see how the ups and downs occurred as the volumes are picking up. Well, we're already high. The volumes in the trading ranges are already high. So again, don't be surprised if the near-term highs and lows look a little bigger, but keep in mind that they're only bigger because of the rally ahead of time was this big. So they're not going to be that same unless you went all in on some positions today or yesterday or Friday, then it's going to really hurt you. But watching these videos and how we talk about every day, position size small, keep things small. We're walking a tightrope. Between the two towers right now, the twin towers. Risks are very elevated. We accommodate those risks by how we manage our positions and what strategies we use, and we're just not aggressively bullish right now because we know there could be some near-term volatility right now, more highs and lows that could really cause me some late nights if I were going all in on some aggressively bullish positions right now. Volatility jumped up to almost 14. We've seen this before. We saw it in December. We saw it in November. We typically see it every month, right? The range for the VIX every month is 4 or 5 points. Well, we started with a move down to 9, which means at some point in time this month, according to the ranges we get every month, now we're going to have a move up to 13 or more to have that 4+ point range. That's typical. That's actually pretty low for the VIX. But at least, that's kind of a minimum range. And we knew that we weren't going down to 5, or we weren't going down to 6 if we were, with the range starting at 11. So we knew after getting down to 9, we had to go up. We've been going up. We broke out of this little triangle we talked about before, broke out to the upside, not just on an absolute basis, but you can kind of see too on a relative basis too, getting up to the highest closing level that we've seen since August. So pretty volatile day, and again, we're just barely off of the all-time highs. In fact, when you look at the intraday chart again and go back to the 4-week range, and we're close to moving that 4-week range up, but we're still 20 points wide, and that's how close with today's pullback. That's how close we are to the 4-week high. And the midpoint of this 4-week range is down to 7 points away from here, from 284. We can come down to 282, 281, 280, and not skip a beat at all. Even though it would be another 4 points down, and that would pretty much wipe out last week's range. There's 281, 280 is the low point of last week's range. It's where we opened last week. Even a move down to that low point would still just easily be contained within the upper half of this large 4-week range. So in other words, nothing too crazy to write home about, but it's near-term volatility. And so that's what happens when you have a range, a 4-week range, at the end of a bullish move that's that wide. It's not surprising to get that wide at the end of a downward move, and we typically will come down, and because volatility is higher, we'll bounce up to the top pretty quickly. We can go right through that midpoint of the 4-week range very fast, but when we're at the top end, usually we just kind of grind away in here, and the problem is the upper half of this 4-week range is just really big right now, which will lead to bigger ups and downs because of it. All right, let's talk about what's driving this price action. And you can see basically it was just a reversal of the kind of dominant trends. The dollar was up, and everything else that we've talked about before in terms of what drives, how the dollar impacts all these other asset classes. Everything played out to form. The only thing that didn't quite play out to form, though, is previously bond yields or bond prices have gone up here, and you can see bond prices. With the dollar, yields have gone down, but even with the strong dollar, yields went up again. So that's a little bit of a break from the norm. So if we take a look at like a long-term view, what that means here, the 10-year note, the 10-year yield on a long-term chart. Let's take a look at a longer-term chart here. Basically, it's cleared its way up above 2.6%. It's holding that breakout, which we haven't had in the past few years. Early 2014, end of 2013, when QE3 was ending, right? So QE3 in its full force was ending at the end of 2013, beginning of 14. It tapered all the way through 14, and then we've had, then we got rid of it, and this is what happened with no QE. And of course, then we had the election and now fiscal stimulus, these hopes for fiscal stimulus here to replace the monetary stimulus that we're getting over here, and that's brought us back up to levels that we haven't seen, at least on the way up. You know, and again, it always bugs me. One of my pet peeves is when they say, well, we haven't seen these levels since 2014. Well, we were coming down from 3% in 2014. So the last time we went up and hit these levels on the way up was 2013 in the height of QE3. And so, and then before that, you can see how we were coming down from levels from 4% and 4.25%. At the height of the, here in 2008, when things were really hitting the fan, the 10-year note yields was at 3 3/4, 4%. So the fact that we're at 3 or below 3% still is really nothing compared to long term where we've been on this. And you can see we're just basically breaking long-term trend lines, however you want to draw them. And right now, the next significant high point obviously would be the 3%, and that appears to be where we're headed. So that's the only break for the norm. You can see here with the dollar, bond yields or bond prices have been down with the dollar, but not today. Today the dollar rallied a little bit. In fact, really since the dollar hit its low point on Thursday, because remember the dollar started to bounce up on Thursday off that low point, and then Friday pulled back a little bit more. But really, since Thursday's the low point here, when the dollar hit that low, up to through today's close, there's a large cap index outpacing the small cap index. You can also see U.S. stocks outpacing international stocks, and you can see gold and crude oil declining during this bout of U.S. dollar strength, which off that low point is up now 1%. And U.S. stocks are up too. They're pulling back from their highs, but they're up too. And you can see emerging markets had a really good day on Friday. Everything kind of bounced up on Friday when the dollar pulled back, and then reversal. So now the only thing, again, like I said, the only thing that didn't bounce up today as expected, you can see here when the dollar rallied, so did long-term bonds. That wasn't the case today. And partly you can see, from an economic calendar standpoint, the only thing that came out today was income and spending. And you can see, look at income levels on a year-over-year basis really starting to take off. That's going to start to raise even though the economic surprise index is starting to really fall pretty rapidly back down to 35 from very high elevated levels. But that's not surprising. That's what it does when it gets to these high levels. It's put some pressure on interest rate hike expectations for March, but not to the fact that we're not going to get one. But you can see now the odds of getting a second one are starting to ramp up by March. So now very low. We're most likely not going to get one, but you can second one. So that would be one here in January right now. We're most likely not going to get that. But you can kind of see how the odds of these low probability moves are really starting to ramp up again because of stuff like this. These economic indicators are looking very strong, and of course equity valuations are very high, and that's, as we've seen in the past, something that the FOMC pays close attention to. From a sector rotation standpoint, energy, materials, technology were leading the way higher. You can see now energy and materials are lagging behind, losing some of that outperformance. Previously, consumer discretionary, healthcare were kind of matching the market, a little bit above, a little bit below, but now they've taken off, and those are your two biggest winners. And consumer staples has also started to, after really lagging behind, started to come up too. And the only things really, of course, that will have a hard time coming up is utilities and real estate, because of that move higher on yields as it makes its way to 3%. That's going to continue to put pressure on here. There's going to be opportunity here eventually, and we're going to keep our eyes peeled for when we can take advantage of that. But as long as yields continue higher, that's going to put pressure in these two interest rate sensitive areas. But these areas like healthcare, if I were to go out further here, and let's not go to year to date because that's only a few weeks. If you take a look at healthcare, healthcare is this kind of bluish line right where my cursor is. If this is for a 3-month period here, 60 days, you can see healthcare has been lagging the market. There's the broad market in black. Healthcare has been lagging the market right up until about that point, right to basically this year, and then it started to close that gap, and it's now it's kind of crossed it from a 6-month return and crossed up above that. So healthcare, and we've looked at a few healthcare names, that's really starting to take advantage and start to really move higher. Consumer staples had a good run with consumer discretionary stocks late last year, but then really from about this point on to, I don't know, right in there, consumer staples really struggled, lagging behind the market. So you can see 1%, and of course real estate and utilities lagging behind too. But from that point, that's when the gap for that was the biggest. From that point on, you can see consumer staples is actually outpacing the market. So for the last couple of weeks, along with healthcare and consumer discretionary. So there's some opportunity in those two areas here, consumer staples and healthcare, to find some, while some of these previously strong sectors like materials and energy are starting to pull back a little bit. One sector in that consumer discretionary area that had a bad day today, it's been doing really well relative to the S&P 500 recently, but the last couple of weeks, this is a relative strength chart right here, last weekly chart of home builders relative to the S&P 500. And you can see there's been a pretty sharp 2-week decline. But this is a relative strength chart. You can see how, we've gotten, and we had a peak in 2013, then a lower high in 2015, then a lower high now as we head back below the 200-day moving average after a brief move up above it. Similar to what you got right here, right? So that being the case, but you notice XHB, which is the actual ETF in blue, it's gone up to higher highs every time. So every time it's gotten up to higher highs, it's kind of been diverging with its relative strength with the S&P 500. So showing the price showing a little bit more strength than it should, according to that model. We take a look at one stock within that sector, DHI, and we talk about how, again, you can see how it grinds, how that MACD grinds down to zero. Well, now we're breaking below zero, and you can see we got earnings coming up here pretty soon, so it's going to make this options really expensive. But you notice this stock really doesn't have big, sharp moves on earnings. Here's some of the other examples of when we've had earnings. Nothing that's really broken it out of its range, and you can see the stock is already breaking out of its range. In fact, you had some support. You could say you had some support right around 50, maybe 51. Well, we're already back down. Today's move was a sharp decline down with heavy volume down below 50 and making a run lower. So if you say, okay, well, yes, we have really expensive options with earnings. What if we just sold that $50 option, bought the 55 for protection? And remember, the 55 is like higher than it's ever been. Again, go to a long-term chart on this, and these are all-time highs for DHI. So if I were to say, okay, buy that 55 for a protection, then I've got a pretty decent credit here, about 30% return on risk, and you notice that I've got pretty decent odds of getting it. And if I were to set that slice to break even and then put that slice up on the chart, and you also see too, we're breaking below the lower Bollinger Band, which also, and that $55 strike, again, we don't get big moves on this on earnings. That $55 strike's way up above the upper Bollinger Band. So you've got some pretty decent protection from a resistance standpoint here, from a technical perspective. Well, there's your break-even level. So if we were to get back up above that basically the moving average in between, then we know, okay, this breakout to the downside has been nullified by the earnings announcement. We'll take whatever loss we get, and you can see, we've got, about a $130 loss at 52.5. That's a little bit more, but about what we're going to try to get from a maximum gain standpoint. That 52.5 is like going to be right up there. So we've got some wiggle room here to keep a 1-to-1 reward to risk ratio, but have a pretty decent odds of getting it because of how expensive those options are now, and because from a technical perspective we've already got the breakdown below support today, and knowing that previous instances of earnings announcements haven't really broken out of a range or out of a trend, like we're already getting right now. So it's a way to again make a little bit of a bearish trade, nothing aggressive. Yes, we're really bullish. Yes, we're going to get some near-term volatility. We're kind of picking and choosing how we're adding. We added a bearish trade previously on Apple with the calendar spread, with coming into its earnings this week. So that was something we've looked at previously. Here's another way that we can pick and choose and be a little choosy about the types of bearish strategies, bearish trades we add to our active trading portfolio when an intermediate run has come to its fruition, it's very mature, and we start to get some near-term volatility. So as always, thank you very much for watching. I appreciate the time that you spend day in and day out watching these and letting me know and engaging with the comments and the thumbs ups and the retweets and the likes on Twitter and on Facebook. Keep those coming. Remember, again, to subscribe to the YouTube channel down below if you haven't already. Follow on Twitter for more content I put out, as well as join the Market Outlook community on Facebook. Have a great evening, everybody. Brandon will be coming back on this week on a regular schedule, so we'll get him going here on a regular schedule here. So look for him this week, and we'll see you all next time.